Standard policy provisions, options, and riders for life insurance. Intent to murder. If it is proven that the applicant applied for a policy with the intent of murdering the insured for the proceeds, the insurance company can contest the policy and its claim. Since the policy did not have a legal purpose from the start, the insurance company may simply deny coverage. The policy owner is powerless to enforce such a claim, as no claim of law will force an insurer to provide coverage under these circumstances. Assignment provision. People who purchase life insurance policies are commonly referred to as policy owners rather than policy holders, because they actually own their policy and may do with what they wish. They can even give them away, just as they can give away any kind of property that they own. This transfer of ownership is known as assignment. The assignment provision in life insurance contracts sets forth procedures necessary for ownership transfer. This procedure usually requires that the policy owner notifies the company in writing of the assignment. The company will then accept the validation of the transfer without question. A policy owner does not need the insurer's permission to assign a policy. The new owner is known as the assignee. For example, if an individual gave a policy to his church as a donation, the church would be the assignee. An insurable interest does not have to exist between the insured and the assignee. As the owner of the policy, the assignee is granted all the rights of the policy ownership, including the right to name a beneficiary. If the assignee does not change, the beneficiary designation, the proceeds will be paid to the name of a beneficiary. If the assignee does not change, the beneficiary designation, the proceeds will be paid to the beneficiary named by the original owner. However, the assignee does not have the right to change the beneficiary as long as the original beneficiary designation was revocable. If the policy owner names an irreversible beneficiary, meaning the beneficiary cannot be changed, the policy owner must get the beneficiary agreement to any assignment. There are two types of assignment: absolute and collateral. Under absolute assignment, the transfer is complete and irreversible, and the assignee receives full control over the policy and full right to its benefits. collateral assignment. A collateral assignment is one in which the policy assigned to a creditor as a security or collateral for a debt. If the insured dies, the creditor is entitled to be reimbursed out of benefit proceeds for the amount owed. The insurance beneficiary is then entitled to any excess policy proceeds over the amount due to the creditor. Though there are many exceptions, most jurisdictions will not allow any assignee to change the benefit designation if it was originally designated irreversible. Accelerated benefit provision. Until recently, traditional whole life insurance policies provided cash benefits payments in the event of insured death or the rare case of an insured living to a contracted maturity date. The only way an insured could access the policy's cash value while living was through policy loan or policy surrender. If an insured was faced with a life-threatening medical condition, the life insurance policy could provide no immediate financial relief. If an insured was faced with a life-threatening medical condition, the life insurance policy by design could provide no immediate financial relief. For example, a $100,000 policy for a 75% accelerated benefit would pay up to $75,000 to the terminally ill insured, with the remaining $25,000 payable at death benefit to the beneficiary. When the insured dies, accelerated payments can be made in a lump sum or made in installments over a special period such as 1 year. This provision is given without an increase in premium. Suicide provision. The suicide provision found in most life insurance policies protects the insurer against the purchase of a policy in contemplation of suicide. With this provision, a life insurance policy discourages suicides from being stipulating a period of time, usually 1 or 2 years from the date of the policy issued, during which the death benefit would not be paid if insurer commits to suicide. If this happens, the premiums paid for the policy would be refunded. Of course, if an insured takes his own life after the policy has been forced for the period specified in the suicide clause, the company will pay the entire proceeds just as if death were from natural causes. Misstatement of age or sex provision. The misstatement of age or sex provision is important because the age and sex of the applicant are critical factors in establishing premium rates for life insurance policy. To guard against a misunderstanding about the applicant's age, the company reserves the right to make an adjustment if the age of the insured is misstated. Likewise, an adjustment is made if an applicant's sex is incorrectly indicated in a policy because premium rates for females are generally lower than males. Normally, such adjustments are made either in premium charges or in the amount of insured. Assume an error in age is discovered after the death of an insured. If insured was younger than the policy showed, the amount of the proceeds would increase to a sum the premium paid would have bought at the correct age. If the insured was older than the policy indicated, the amount of the proceeds would decrease to whatever premium paid would have purchased the correct age. If an error is discovered while the insured is living, the premium will be adjusted downward if the insured is younger than the policy shows, and refund of the premium overpayments will be made by the same token. If the insured is older than the policy indicates, the company will either adjust the premium upward and require the difference in premiums or reduce the amount of insurance into what it should be for the amount of the premium being paid. Automatic premium loan provision. A provision that is now common only added to most cash value policies is the automatic premium loan provision. This provision authorizes the insurer to withdraw from its policy cash value the amount of override premiums if the premium has not been paid by the end of the grace period. The amount withdrawn becomes a loan against the cash value bearing the rate of insurance specified in the contract. If the loan is not repaid, the interest will be also be deducted from the cash value. Should the insured die, the loan plus the interest will be deducted from the benefit payee. Depending on the insurer, this provision may be standard to the contract or added as a rider with no additional charge to the policy owner. Note that the provisions may be very beneficial for the policy owner who forgets to pay the premium within the grace period or cannot pay the current premium because of financial difficulties. Most importantly, the policy does not lapse and coverage continues. If the policy owner allows the automatic premium loan to continue, pay the premiums, the policy eventually will lapse when the cash value is reduced to nothing. The owner would then have to reinstate the policy and pay back the loans. Other policy provisions. There are two additional provisions that appear in all policies. The first is beneficiary designation, where the policy owner indicates who is to receive the proceeds. The second is the settlement option, where the ways in which the proceed can be paid out or settled as explained. Beneficiaries and settlement options are discussed later. Discretionary provisions. A discretionary provision is discretionally authorized to the insurer when determining the eligibility of an insured for benefits under the policy. This provision limits the way a court can review a claim denial and make it difficult for the court to conduct a fair review of claim. Some states have enacted laws that prohibit discretionary provisions because they are designed to protect the insurance company. Most life insurance policies contain restrictions that exclude from the coverage certain types of risks. If there were no exclusions, premium rates would be much higher.